February natural gas futures are trading lower on the first session of the year as updated weather forecasts point to a significant loss of heating demand during the first half of January. Meanwhile, some bullish traders continue to argue that very cold conditions remain possible in the back half of the month, and if that cold materializes, prices could still recover, with more than half of winter yet to play out. Nevertheless, current storage projections are not supportive of a bullish case. Only the January 8th EIA report is expected to show a larger than normal withdrawal, reflecting the colder weather underway now. Beyond that, the rest of January looks decidedly unbullish, with storage surpluses projected to grow rather than contract. As a result, bullish traders are increasingly desperate for signs of a late January or early February cold shift, which helps explain why prices are attempting to carve out a floor near the $3.60 level. Meanwhile, today's natural gas rig count report showed a modest decline to 125 rigs. While the drop itself is minor, the broader takeaway is that the rig count remains comfortably above the 120 level. This follows a notable recovery from last year's lows near 100 rigs, highlighting that producers have largely maintained elevated activity levels despite recent price volatility. From a technical perspective, the broader structure still leans corrective rather than impulsively bullish. The recent rally stalled below key resistance, suggesting that sellers are still active on strength. Momentum indicators are flattening, signaling hesitation rather than renewed buying interest. As long as the market remains capped beneath the upper resistance band, rallies are likely to attract selling rather than trigger follow-through. On the downside, the $3.60 area is emerging as an important near-term support zone. This level represents both a psychological threshold and a short-term balance point where buyers are attempting to slow the decline. A sustained break below this area would likely expose deeper downside, opening the door to a move toward the next support region around $3.40, where longer-term buyers may become more active. Looking ahead, the near-term forecast remains cautious to bearish unless weather models begin to consistently introduce colder risks for late January or early February. Without a clear catalyst, price action is likely to remain range-bound, with a downside bias. However, given the remaining length of the winter season, volatility is expected to stay elevated, leaving the market vulnerable to sharp, weather-driven reversals should forecasts materially change. Don't forget to drop a comment, and feel free to buy me a coffee or YouTube super thanks if you'd like to help keep this channel going. Thanks for being here and I'll see you in the next one.